Hi, my name is James Asch, and this is our group's report on CVP analysis at Dunkin' Donuts. Before we can jump into CVP at Dunkin' Donuts specifically, first we must understand the concept. Cost volume profit analysis, or CVP analysis, examines the effects of different cost and volume levels on operations profits. CVP analysis is employed when looking for a break-even point or a desired net profit, which in return can help managers make important business decisions. Product contribution margin is managed via CVP analysis and is the difference between total revenues and total variable costs. CVP analysis requires costs to be fixed within a given product level, which means they are not moving throughout the fiscal year. It is also assumed that every unit produced will be sold. These are the assumptions for CVP to be effective. The most common and debatably the most important CVP formulas are those of break-even and profit equation. Break-even sales simply equals the fixed cost divided by contribution margin. This would mean that you will see how many units you need to sell in order to break even, which would be your contribution margin equaling your fixed cost. You're looking for a ratio of about 1. This would mean that you are at 0. You're not in the negatives, but you're also not in the positives yet. The profit equation is basically the same thing, except on to the fixed costs, you would add your desired gross profit. You would do this by, say, your fixed cost is $60,000 and your desired profit is $20,000 annually. You would add those two together and you would get $80,000 divided by your contribution margin to find the amount of units or total sales you must sell to reach your goals. Now I'd like to talk about Dunkin' Donuts for a little bit. Dunkin' is a multinational coffee and donut fast food chain, and as of January 2023, Dunkin' Donuts has about 9,200 franchisee-owned locations in the United States. They have about 13,000 locations nationwide. Now, as a franchisee, or a franchisor, Dunkin' Donuts receives a royalty charge of 5.9% of each location's gross sales, as well as a brand fund fee of 5% of gross sales, adding to a total combined percentage of 10.9% of every location's gross sales. Now, a franchisor will buy a building and help a franchisee get through. This is the case. Most fast food chains are franchisors who sell to franchisees, and in return, they get a percentage of that location's gross sales. Dunkin' Donuts has a couple core assets that they use to operate. First of which is low cost of goods. Customers, and the loyal customers, consider Dunkin's to be quite reasonably priced compared to the competition. Coffees are fairly cheap compared to other coffee shops, which is one of their most, if not the most popular item on their menu. A single donut can cost only 99 cents, and their breakfast bakery sandwiches cost from the $3 to $4 price range. Supply chain reliability. Dunkin' has ensured the consistency, quality, and availability of products which customers do not take for granted. The reliability of the supply chain allows the company to operate with a smaller than normal inventory, which saves money. The inventory method, which is first in, first out, is a set specific quantity that is made to last for a week, and managers have the option of adding cases of products up to 24 hours prior to their weekly delivery in case they want an excess of one item. Dunkin' makes sure that new stores are constructed in places that appeal to their demographics, have good traffic patterns, and have high population density. By doing this, both the business, Dunkin', and the franchisees profit more. Dunkin's market strategy is very smart as they think about what would be most effective where the chain is located. For example, in northeast locations, you will often see a less complex, more reliable menu as they don't need or want as many options. For example, there are a lot of things like black coffee rather than a frappuccino with sprinkles, where in other places the demand would be higher for a frappuccino with sprinkles. They're very good at seeing their target market. Next, I would like to talk about the uses of CVP analysis at Dunkin. Dunkin could employ this analysis to determine what is assisting them in achieving their target of net income per site annually and what is hindering them. Dunkin might decide to conduct a CVP analysis on the entire business, which would be all locations at once, but it wouldn't make much sense. As they are a franchisee and each location has different demand, all the contribution margins will be different, even if fixed expenses stay the same, making the numbers not as reliable or accurate. If Dunkin, this is what they do, measures CVP analysis per franchisee, they have a more accurate representation of what these numbers would do to each franchisee. Dunkin would decide to stop selling a particular breakfast sandwich or item in a particular local region if it was costing too much in variable expenses per unit compared to the selling price, which in turn loses profits. If Dunkin wanted to break even, they could use CVP to calculate the number of sales they would need to generate in order for gross revenue and total expenses to equal, or fixed expenses and contribution margin. Dunkin might utilize CVP analysis to determine whether a recent addition reduce the sale units needed to reach a break-even, or increase the number of units required to achieve break-even if the addition impacted variable expenses and gross revenue. For the purposes of this illustration, let's assume that this one location has an annual fixed expenditures of $60,000 and that it costs $1.95 per unit to produce the goods it sells for $4, coffee, donuts, etc. To break even, where fixed costs equal contribution margin, 29,269 units would have to be sold during the year. Here's the equation right here. You would divide fixed costs by the contribution margin, which would be the sale price of one unit minus the cost of goods sold per one unit. Let's say Dunkin wants each site to generate a $19,000 profit annually. They would add the value to the fixed costs and find that they need to match $79,000 a year. So we would have the same equation, but rather than $60,000 for fixed costs, we'd have $79,000 for fixed costs plus desired profit margin, giving us 38,537 units needed to be sold during the year. However, this is not always the best strategy. As I talked about earlier, pooling all companies together doesn't make much sense in this scenario. As I was saying, it's important to note that a chain that has so many products and locations, like Dunkin, will need to use total sales and total variable expenses in this formula instead of the units, because every product for every location is going to have different contribution margins. For example, let's say a location expects to end the year with $60,000 in fixed cost, $120,000 in total sales, $70,000 in variable expenses, and they want to generate a $20,000 profit. The CVP equation would look like this. First, to find the contribution margin ratio, you would do 120,000 divided by 70,000, which is the fixed cost minus the variable expenses. The total sales minus the variable expenses. Then you divide that number by the total sales, getting your contribution margin ratio. Then you take 80,000, which you get from the $60,000 in fixed costs and the $20,000 in desired profit, and you divide that by the contribution margin ratio, getting the total amount of sales you need to generate to reach your profit goal, which in this case is $192,000. This formula is likely what Dunkin' Donuts uses, as they have multiple different priced units making the unit prices a lot harder because each unit costs a different amount. If Dunkin wanted to add an item to their sales mix that would change the total number of sales and variable costs, the company could use CVP analysis to see what these changes would do to the sales needed to break even. If the value of the needed total sales rises, Dunkin would likely choose to not move forward with the new item, as it would generate less profit. It would take more sales to get to the desired profit. However, if the total sales needed were to decrease after the change, it would tell management that that the new item would drive more profits than before, and would be a good idea to add it to the menu in locations where the demand would be high. As you can see, CVP analysis is vital for Dunkin' Donuts, for managers to make important decisions regarding the future profits of the firm. Here are our work sites. Thank you.